Qantas Group has announced a sweeping strategic restructure, including the closure of its Singapore-based low-cost carrier, Jetstar Asia, as part of a plan to modernize its fleet and refocus on core markets in Australia and New Zealand. The move will release up to $500 million in capital, which Qantas will channel into its historic fleet renewal program and other long-term growth initiatives. Jetstar Asia's 13 Airbus A320s will be progressively transferred to support operations in Australia and New Zealand, where they are expected to create more than 100 new jobs and enable Jetstar Airways to expand its low-fare offerings. Some of the aircraft will also bolster Qantas's regional services, especially those tied to Western Australia's vital resources sector. Jetstar Asia, a staple in Southeast Asian aviation for over 2 decades, has been struggling with surging operational costs. Supplier expenses have soared by up to 200%, severely undermining the airline's cost structure and profitability. Qantas Group CEO Vanessa Hudson paid tribute to the team, calling Jetstar Asia a pioneering force in the Asian aviation market. Despite efforts to manage the financial challenges, Jetstar Asia is projected to report an underlying EBIT loss of 35 million Singapore dollars for this financial year. The airline will wind down operations over the next 7 weeks, with its final day of service scheduled for 31st July 2025. The closure will affect only Jetstar Asia's intra-Asia routes from Singapore. Jetstar Airways' domestic and international operations in Australia and New Zealand, as well as Jetstar Japan, will continue as usual. Jetstar Airways will also maintain services to destinations in Asia, including Singapore, Thailand, Indonesia, Vietnam, Japan, and South Korea. Qantas has pledged to support affected passengers and staff. Customers with existing bookings on impacted Jetstar Asia routes will receive full refunds or rebooking options, and employees will be offered redundancy benefits and redeployment assistance, including potential transfers within Qantas or to partner airlines. Despite the shutdown, Singapore remains a strategic international hub for Qantas. The group maintains nearly 20 codeshare and interline partnerships through Changi Airport, ensuring continued connectivity across the region. The closure aligns with Qantas's broader strategy, which includes a fleet renewal of nearly 200 aircraft. Deliveries include the first Airbus A321XLR later this month, and the Project Sunrise A351,000 ULR in 2026. Hudson underscored the importance of disciplined capital allocation, emphasizing the reallocation of resources to high-performing business segments. The financial hit from Jetstar Asia's closure will total $175 million, including redundancy costs and fleet restructuring, with the bulk felt in FY25 and FY26. However, Qantas expects to offset these costs through tax benefits and growth in Jetstar Airways operations. Meanwhile, group international capacity is forecast to grow by 9%, while group domestic growth has been curtailed due to Cyclone Alfred, which shaved $30 million off earnings. Still, demand remains strong across both segments, and Qantas expects unit revenue and capital expenditure to stay within previous forecasts.